In this tax course module, we'll discuss Schedule D and Form 8949, capital gains and losses. If you buy low and sell high, you'll be a successful investor. You'll also have capital gains. The IRS defines a capital asset as almost everything you own and use for personal or investment purposes. That's a lot of stuff. So technically, yes, you'd have to tell the IRS about that collector's item Beatles record that you sold for a nice profit on eBay. But the most common taxable assets are securities, real estate, and valuable collectibles. Securities are any kind of financial instrument or investment contract that has value. Examples are stocks, bonds, and options. And it's important to understand that you'll only be taxed on those stocks and securities that you've sold in the past year. If your stocks go up during the year, but you hang on to them, you won't be charged capital gains tax. If you use a broker to help you buy and sell stocks and bonds, then the brokerage firm will typically send you a form at the beginning of the year called a 1099-B, proceeds from broker and barter exchange transactions, and this form lists all of your earnings and losses from the sales of securities. Here's a typical generic 1099-B, and on this 1099-B, it gives you information such as the date the stock was acquired, the date it was sold, the cost of the stock or the security, and how much you sold it for, and whether there's a short-term gain or loss or a long-term gain or loss. And it's typical for the brokerage firm to list the earnings as net proceeds, meaning how much you earned minus any commissions and fees. If they list gross proceeds, then you'll have to deduct the commissions and fees yourself. If you sell real estate or property either for personal or business purposes and you make a profit from that sale, then that also qualifies as a capital gain. Different tax rates apply to sales of personal and business property, and thanks to the Taxpayer Relief Act of 1997, there are significant tax breaks when you sell your primary residence, your personal home. According to this 1997 law, if you've used a home or an apartment or a trailer or even a houseboat as your primary residence for at least 2 out of the last 5 years, you can exclude up to $500,000 in capital gains from the sale of that property. The $500,000 exclusion is only for married couples who file jointly. Individual filers get to exclude $250,000. That means you don't have to pay taxes on the money that you made or the profit from selling a primary residence unless the earnings exceed $250,000 or $500,000 depending on your filing status. To qualify for this exclusion, during the 5-year period ending on the date of the sale, the taxpayer must have owned the home for at least 2 years. This is called the ownership test, and lived in the home as his or her main home for at least 2 years. This is the use test. And in addition, during the 2-year period ending on the date of the sale, the taxpayer must not have claimed an exclusion on a gain from the sale of another home. Figuring the gain or loss on the sale of a home is based on the selling price, the amount realized, which is the selling price minus any selling expenses, the basis of the home, and the adjusted basis, the cost of the home plus any capital improvements that were made. Keep in mind, a loss on the sale of a personal residence is not deductible on the tax return. Even if any profit is not taxable, a taxpayer who receives a Form 1099-S for gain or loss on the sale of a main home has to report this information on Form 8949, Schedule D, and ultimately on the 1040. Sales of art, rugs, antiques, jewelry, precious metals, wine, stamps, coins, and other valuable collectibles are taxable as capital gains. And we'll talk more about capital gains tax rates and how they're calculated later. All right, let's talk about calculating capital gains. The first step is to calculate exactly how much capital gain income that you've earned in the last year. Sounds easy enough. All you have to do is take the sale price of a capital asset, which is a stock, real estate, and so on, and subtract the original purchase price. But it gets a little trickier if you're not the person who originally purchased the asset or the investment. We mentioned determining the cost basis. So how do we do that? Well, the original purchase price of an investment, like stock, other securities, or investment property, is known as the cost basis, the original purchase price. There are several different ways to calculate this. If you purchased the investment, then the cost basis is simply the price that you paid for it. If you inherited the investment, then the cost basis is the value of the investment on the date that the original owner passed away. If you received the investment as a gift, then the cost basis is the original purchase price of the asset, unless the investment was worth less than that amount when it was given to you. The holding period. Determining the holding period. So once you've figured out how much you've earned from the sale of each asset, next we need to figure out how long we've owned each asset. This is called the holding period of an investment, and it's divided into two categories, and each category has a different tax rate. Short-term investments are those investments that are sold less than a year after they were purchased. Long-term investments are held for at least a year before being sold. Holding period of an asset is measured in calendar months beginning on the date after the acquisition and including the disposal date. For example, if 100 shares of stock are purchased on February the 14th, 2015, the earliest date on which the stock can be sold and the gain or loss can qualify for the long-term holding period is February 15th, 2016. So why is it important to determine long-term versus short-term? Well, short-term gains are taxed at regular income tax rates. Long-term gains qualify to be taxed at a lower tax rate. Starting with tax year 2011, capital gains are reported using Schedule D and an additional form, Form 8949. This was a major change from previous years when only the Schedule D was used. Details regarding individual trades are reported on the Form 8949. The totals from this form are then summarized on Schedule D, and the Schedule D figures transfer to the 1040. So here's an example of a Form 8949 organized much like a spreadsheet with all of the essential information about each investment that you sold during the year. Capital gain or loss is reported for each transaction, then the total gains or losses are calculated. You'll have either a net profit or a net loss from all of the trades. To complete the 8949, you need the following information for each sale, each transaction: a description of the property, the date acquired, the date it was sold, the amount it was sold for, and the tax basis or the cost. And to help with these entries, Again, the 1099-B is sent by the asset broker. On the Schedule D, you'll see 3 sections. Part 1 is for short-term capital gains and losses. Part 2 is what's used to report long-term capital gains and losses. And Part 3 is the summary of both short and long-term gains and losses. We follow the instructions in Schedule D, Part 3, and when finished filling out the form, we put the total amount on Form 1040, line 13. So, Form 8949 flows to the Schedule D. The Schedule D flows to the 1040. Now, when long-term capital gains are included in total income, then federal taxes are calculated using the Qualified Dividends and Capital Gains Tax Worksheet, not from the tax tables. The capital gains tax rate can actually be 0 if the taxpayer is in the 10 or 15% income tax bracket. So if we look at Richard Investor's tax return and how to calculate his income tax on his capital gains and the rest of his earnings, we first find the taxable income from page 2 of the 1040 to use for the capital gains tax worksheet. So, looking closer, capital gains income can have a big effect on the tax return. So we found from his 1040 that his taxable income is $46,050. Tax from the tax tables is $7,290. However, looking at his 1040, the actual tax calculated on the return from the capital gains tax worksheet turns out to be $6,403. This is a difference of $887. So you can see what a big difference capital gains tax rates can have on the return. So here's an example of the capital gains tax worksheet, the qualified dividends and capital gain tax worksheet. We skip down and we see where all of the action takes place down there on lines 26 and 27. We saw that the tax from the tax tables was $72.90, but the tax on the income, $64.03. So let's jump back for just a moment and talk about the capital gain distributions. Remember our discussion of the Form 1099 DIV that gets reported on line 9 of the 1040 in a previous module? Well, if a taxpayer has both a Form 1099 DIV and a Form 1099-B, then any capital gain distributions from the Form 1099 DIV are added to the Schedule D. So here's an example of a 1099 DIV with total capital gain distributions in Box 2A of $650. So exactly what are capital gain distributions? Well, capital gain distributions are capital gains. It's an increase in the value of an asset that's passed on to an investment company shareholder. How do they work? Well, for example, let's assume that the Acme Company's mutual fund invested well during the year, and they realized $1 million in net capital gains. The fund has 10 million shares outstanding, and you own 1,000 of them. Because you own 0.01% of the fund's shares, that means you're entitled to 0.01% of the net capital gains, or, in this case, $100. So on the Schedule D, the capital gain distributions are added to line 13 in Part 2 of the Schedule D, and they also get taxed at the long-term capital gains tax rate. Now, what happens if I lose money on my capital investments, on my sales of stock? For example, let's say David Macaroon sold 3,000 shares of SRO stock for $2,000 on March the 1st, 2016. He purchased those shares on January the 10th, 2009 for $10,000. So he's got a loss of $8,000 to report. How does he report this capital loss on his 2016 tax return? Well, page 2 of the Form 8949 lists the long-term loss of $8,000 on the sale of the stock. The loss then transfers to Part 2 of the Schedule D. The Macaroons, however, can only claim $3,000 of the capital loss on their 2016 tax return. Well, what happens to the rest? Well, there's a capital loss carryover for the next tax year. By law, a taxpayer can only claim $3,000 in capital losses for the year. Again, the rest gets carried over. So, the capital loss carryover rules very quickly. First, any capital loss that's not used in the current year can be carried over indefinitely in order to offset future capital gains. For example, if you have $10,000 of capital loss after using $3,000 to offset ordinary income, $7,000 will carry over to the next tax year. In that next year, if you have $5,000 of capital gain, then you can use $5,000 of your loss carryover to offset this gain and use the remaining $2,000 to offset your ordinary income. Second, $3,000 of a capital loss can be used to offset ordinary income. For example, if you have a $10,000 capital loss and no gains, then you get to use $3,000 of the capital loss to deduct against your ordinary income. If your ordinary income is $50,000, you'll get to deduct the $3,000 in capital loss, and you'll only pay tax on $47,000 of your ordinary income. Third, capital losses are used to offset capital gains. For example, if you have a $10,000 capital loss and a $10,000 capital gain, they'll offset each other. So in summary, what is a short-term holding period? 1 year or less gets taxed at regular income tax rates. What's long-term? More than 1 year gets taxed at a lower rate than short-term. Brokers report information about the sale of stock on a Form 1099-B. Brokers should report the cost or other basis and whether the gain or loss is short-term or long-term. We use Form 8949 for reporting details of capital gain or loss transactions. Short-term transactions go on 8949 page 1. Long-term transactions, Form 8949 page 2. The 8949 totals then transfer to Schedule D and ultimately to the 1040. The most net capital loss a taxpayer can take in a single year, as we just saw, is $3,000 and $1,500 if the filing status is married filing separately. Now let's go over some review questions.